retirement numbers that can make you rich. You know, we must know numbers like when to take and start Social Security retirement income, when to take Medicare, but when, how much, and what are the other retirement decisions we need to make that can make you rich or cause you to lose money or really even to cheat yourself. I've covered these in some paid and unpaid speaking gigs recently. And as a CFP professional, I think this is going to be a great use of your time. But these numbers are hard to sequence, and it's about predicting longevity, spending patterns, life events, inflation, markets, healthcare, insurance programs, long-term care, tax changes, changing family needs, plus your changing health. Now, I became a certified financial planner professional from my passion and curiosity about investing, but more so from my late mother in Kentucky who was bewildered with money, yet always wanted to do the right thing. And I think this framework will be really helpful. There are retirement numbers that can make you rich. They are crucial to getting your choices right for you, your spouse, or partner. Plus, some of these numbers keep changing or will change by legislation or regulation. You're watching What's Next with Money, a program with smart insights to guide your financial decisions. The general direction of the number changes is good, but if we do not know the key numbers, we miss money opportunities for our income, net worth, being tax smart, tax optimized, and the chance to coordinate with our family and our spouse. Now, at the end of this video, I'm going to recommend 3 What's Next with Money retirement videos to answer these questions and help you go more in depth with each of these. So here are the 4 retirement numbers we must know. Here's the first, 62. Age 62. This is Social Security early retirement age. And if you claim Social Security at this early age, the earliest opportunity, and still work outside, you're going to be subject to tax penalties on your Social Security checks. It's a taxable earnings limit. If you're under this thing called a full retirement age, which will be our next number, and you will be at age 62, for the entire year, Social Security is going to deduct $1 from your benefits payments for every $2 you earn above an annual limit. Now, for 2024, and these limits change periodically, that limit is $22,320. But worse is the lock-in of a smaller Social Security check, and that lock-in is permanent. This is of a greater concern because the lock-in is for your lifetime, and you are now set at a lower benefit check level. Here's why. You could benefit from an 8% annual increase in your Social Security check each year you delay claiming. Now, this happens from age 62 to 70. Now, remember, Social Security is inflation adjusted, and it's for your lifetime. So the earlier you claim, the more you miss out on that 8% increase. Now, here's our second key retirement number to know. That's age 67. And this is known for most people as full retirement age. And once you hit this age 67 and you're working outside, there are no penalties. So that penalty I talked about earlier goes away on your Social Security check. So you can work as much as you want and not have any benefit deduction. Now, if you retire and are working and claim age 67 in that year, the deduction amount is a little less stringent. It's $1 for every $3 you earn above the annual earnings limit. Now, our third number is age 65. Now, this is a big one. This is Medicare Eligibility Age for non-disabled adults. Some people, when they hit this number, can quit work, or they can go part-time, and then you have health care coverage that is not tied to employment. Now, if you do quit work before age 65, you're going to need to find other health insurance. Now, that could be through work of a spouse, maybe getting on their program, or you might have to tap into Obamacare. And this is happening in age 62, 63, 64, up until age 65. So 65 is Medicare eligibility. Our fourth number is age 70. Now, this is the age when you must take Social Security. The delayed claiming benefit stops. Now, these numbers could change for younger workers with Social Security and Medicare reform, and that would be to help to close the funding gap and make the program more sustainable. Now, the good news is the fixes to fix Social Security and even Medicare are already known, just like in this Social Security Fix-It book. They're known by Republicans and Democrats alike. And it's going to take compromise. And as Winston Churchill once observed about Americans, Americans will absolutely do the right thing, but only after they've nearly tried everything else. So we'll get to it. And we did in the 80s. This is a book about how Social Security reform happened back then, and it changed some of these key retirement numbers. Actually, the full retirement age, age 67, was set back in this Social Security reform. It did make the program more sustainable. So I do have hope for the program. Now, here's another big number that impacts the previous four numbers we just covered. And we've already alluded to this. And that's that 8% annual increase in Social Security check each year that you delay claiming from age 62 to 70. You don't have to wait till 70. You could claim at age 63, 67, 68, 69. But think of the power of that larger check that's inflation adjusted and it will last your entire lifetime. Now, you might ask how I can delay claiming Social Security to get that check, because I really need that Social Security check. Well, here's the question put another way. You might say, how can I bridge my income without Social Security to get that bigger check, that 8% per year increase, while I delay claiming? Well, here are a few sources. Perhaps you have the benefit of a pension. You could do 401k withdrawals kind of early before claiming Social Security. Maybe there's an age differential between you and your spouse or partner, where that person might be working full-time, helping provide you with health insurance, and also the ability to bring that income in. The other thing you could do is even work part-time, or perhaps you have rental income. So you could depend on pension, 401k, work from a spouse, your own part-time work, or rental income to help bridge and build that 8% in the more you delay claiming up until age 70. And coordinating all this with a spouse or partner is just a healthy financial conversation. Another reason not to act rashly, but rationally. And for more bridging ideas, you can see our really cool video, Optimizing Your Retirement Paycheck, and I'll have links. So, bridging to age 65 Medicare, another bridging challenge is health insurance. And you could be on family coverage from a working spouse or tap into the Affordable Care Act, widely known as Obamacare. But you might say, hey, Brent, Social Security, that's a sucker's bet. It's going to go broke and it won't be there for me. Well, most folks 30 years ago, when asked in a survey, which is more likely, is Elvis still alive or will Social Security be there when they retire? And guess what? Elvis won that survey, but I think he's still dead. But wait, even the most dire predictions of Social Security shortfalls mean the trust fund might be exhausted if Congress, all the lawmakers, and the president do not act by 2035. Now, what does this really mean? I'm going to kind of dispel a couple scare headlines. It still means that 83% of Social Security monies that are coming into the system really still come through payroll taxes of working Americans. So every day, 9 to 5, when they get up and work and receive a paycheck, they and their employers are pushing money into the system. Now, a really smart friend of mine at the DC-based Bipartisan Policy Center, who's an economist, really smart guy, says those who are in their 20s or 30s right now, in the worst case scenario about the future of Social Security, will still receive 75% of their expected Social Security payouts if nothing changes. And this friend of mine, Jason, told the Wall Street Journal recently, Getting 75% of planned benefits isn't great, but it's also not zero. Also, other bipartisan reform ideas are being proposed. Remember, we've got the Fix It booklet, and there are many other studies around about reforming Social Security. But they're proposed to help direct more benefits for folks who do not have other forms of retirement savings, to supplement Social Security and shore up the financing of the program at the same time. So kind of a double positive hit. Now, still others might advocate for the expansion of Social Security benefits, but that's going to be very costly. But reform ideas include payroll tax percentage changes as one idea. Another is increasing the annual taxable earnings tax cap is being discussed now. Right now for 2024, that means anybody that earns up to $168,000, they pay into Social Security. But after that, because this is not an entitlement program, it's kind of a pay-as-you-go system, it's not taxed above that. So the idea is to raise that $168,000 earnings tax cap, way up, and that can bring more money into the program. And people also have that right now with Medicare taxes. It's kind of unlimited. It doesn't have that tax cap. Now, if you want to see more videos like this, please hit that subscribe and that like button, and we appreciate it. Now, here are a few other crucial numbers. Age 59 and a half. You may have heard of this one. This is the Roth and Contributory IRA Withdrawal Eligibility Age. Now, there are some exceptions, but basically, especially for contributory IRAs, there's no 10% tax penalty for early withdrawal. And there are some exceptions to this. Now, you might also ask, is Social Security taxable? Most people do pay a federal tax on Social Security income, either at a 50% or 85% of the benefit amount. Now, some states exempt Social Security retirement income from state income taxes: Arkansas, California, Delaware, Georgia, Massachusetts, Mississippi, and a few others. And others do it partially. Check with socialsecurity.gov, SSA.gov, or your state's revenue department for more information. And of course, we know several states have no state income tax, including any tax on retirement income. Now, here's another number, and this one hasn't changed in a while. Our next number is age 70 and a half. Now, this has been around a while, but now it's confined to one aspect of tax law, and it's the Qualified Charitable Distribution, QCD. And this means that people, when they hit that age, if they're charitably inclined and they have, let's say, a large amount of money in their taxable contributory IRA, they can give money to charity up to $105,000 annually. It eliminates an RMD, a required minimum distribution. Now, you don't get a tax deduction for this, but it's like a tax offset because you can pull money out really for no tax, but to give to charity. Now, giving to private foundations and donor-advised funds under this QCD method is not eligible. Now, here's one of our big final numbers, age 73. This is new. This is the new age of RMDs, the new age of required minimum distributions. Now, for most folks, if they don't pull a required amount of money out of their taxable IRA at this time, at age 73, at the beginning of this time annually, they're subject to penalties between 25% and 50% on the RMD amount not taken or corrected. This is another bridging idea for taking IRA distributions early, well before age 73, while waiting to bridge for that larger Social Security check to help it go up 8%. So you could say, I want that check to go up 8% for my lifetime each year from age 62 to 70. But for a portion of that, I'm going to start pulling distributions out. I'm going to elect to do it, not required, from my taxable IRA. And by living off that money, I can let that Social Security claiming decision be delayed and then bank that 8%. So this works out well. Another reason is, since the government has now set the RMD requirement at age 73 much later, if we start taking all those distributions beginning at that time and not whittle it away a little bit, it's going to be really a tax challenge or a collision. We should also consider Roth conversions out of a contributory IRA, taxable IRA, for tax diversification. It's kind of like an early RMD. You're going to have to pay tax on it. You're going to need money to pay those taxes, but you could be pulling that money out at a lower tax rate and not have it all bunch up when you're older. And also consider rolling over actual investment positions. Now, this is something new and something I'm actually doing. Instead of just pulling cash out of a taxable IRA, you could pull over a stock position, a mutual fund holding, all or partial. It doesn't have to be the whole thing, or an exchange traded fund holding those investment positions directly into the Roth. You have to pay tax on that, but that preserves that position that you've already done. And it's fantastic to do when the stocks of those positions that you like are at depressed values. Now, I am doing this aggressively. It's kind of fun. It's for me for tax diversification. And it gives me comfort during market downturns that I can bring over quality positions I have in whole or in part and not having to abandon them. So do your research, and it's great if you're positioned over the long term and don't need those monies early for several years. We also need to assume that you've already done rollovers of other 401k and 403b accounts into an IRA, be it Roth or contributory taxable. But some employers now allow you, as you move from job to job, to think of this kind of 401k consolidation differently. This is the idea of leave no 401k behind, but some employers allow you to take 401k positions and move them right into their plan if it's acceptable. So you might ask your benefits person if that's possible. You may have one from a prior employer that you haven't rolled over, so check that out. Otherwise, it's going to be rolled over to a rollover IRA. Now, another double number is 10/62. Now, this is a very specialized set of numbers for divorced spouses. Now, this is when a divorced spouse can claim some of your ex-spouse's Social Security benefits. Now, there are a few requirements. Your marriage has to have lasted 10 years. You have not remarried or at least age 62. And this is known as a Social Security spousal benefit. Also, for our divorced friends, this could be another great bridging idea to maximize that 8% Social Security check. So please check with socialsecurity.gov or a CFP professional for more information. These rules may change. Now, here's something brand new from Congress, a new $1,000 interest-free, penalty-free pull out of money from a 401k account for a self-defined emergency. You tell them what the emergency is, and then they give you the money. Now, this is one emergency withdrawal per year. The 401k balance or 403b must be maintained at least $1,000. So you have to have $1,000 in there and hold it. But let's say you had $2,000 or $3,000, you could pull out another $1,000 for an emergency. You're going to pay tax on the withdrawal if you do not put the money back. Check with irs.gov and your employer. Now, not all employers have adopted this new feature. It's very new, but they might with you asking about it. Now, this emergency $1,000 401k withdrawal is a great idea, and many folks will contribute to a 401k or a Roth IRA if they can tap the money because they do not have other checking, savings, or a brokerage account or non-retirement money. Now, there are other special withdrawal features like other tax-free IRA withdrawals, $5,000 for adoption expenses, $10,000 from an IRA for a first-time home buyer, and you can only use that once. Now, as I've mentioned, we recommend 3 other What's Next with Money retirement videos to answer questions to help you go deeper into this area. We have curated videos on retirement in the description and comment sections. They include when to start Social Security, optimizing your retirement paycheck, and this is 8 decisions that can build momentum, and recognizing the warning lights on your retirement dashboard. So now you can be more confident in retirement and in life knowing these key numbers, the basic 4, 62, 65, 67, 70, plus that 8% number. So be sure to hit that subscribe and like button, and don't forget to share. I'm Brent Neiser, looking to see you next time on What's Next with Money.